Hi, and welcome to the Interaxis YouTube channel and Interaxis.io. Today we're going to talk about DeFi lending, specifically pools and how their interest is determined. And this is something that was specifically requested by a few people, and I'm going off of a Medium article I saw, and I want to address both of those. Those will be in the notes for this video. So we're going to talk about DeFi lending, specifically pools and interest, and a few dApps or applications that have come out, companies that have come out that you may or may not have heard of. Probably the most used one is Compound. We also have a great one in Nuo. There is the BZX, which has as some of its products Torque and Fulcrum, which are kind of lending protocols. And then there's also DYDX that allows you to lend or borrow, whichever you'd like to do. So first, it is important to understand what these are and how these work. What all of these are, and basically the way they function, is they create a lending pool, right? So if I have extra ETH or extra DAI or something that I want to lend and earn some money, it kind of works like it somewhat works like a bank, right? Right now, if I have extra money, I put it in the bank in a savings or a checking account, and hopefully the bank pays me interest, right? So if this, in the traditional sense, is the bank, I put in my dollars into a savings account, right, and they pay me some 0.01%, some ridiculously low rate of interest. On the other side, the bank is actually making loans and earning anywhere, from 5 to 10% interest on those loans. And those loans could be mortgages, it could be business loans, whatever they are. And in the middle, the bank kind of makes a difference, right? I'm not specifically lending to anyone here, but the bank is essentially acting as a lending pool. The difference is the bank also has a lot of guarantees on my money, right? I'm guaranteed by the federal government of the U.S. up to a certain amount to not lose my money, which is an important distinction, and one of the reasons why banks are so important, and we've needed that centralization for so long. But again, I put my money in here, and the bank's job is really to, one, safeguard my money, but two, lend it out, because lending, debt, is essentially the basis for growth in the worldwide economy. For every dollar of equity investment there is in the world, there's probably $10 of debt investment. What that means is there's probably $10 trillion of debt out there. And again, I'm throwing that number out. I believe I've read it somewhere, but over $10 trillion of debt out there, which is what allows people to be able to build businesses and have homes and everything, because not everyone has the cash available to just have a cash society. So we have a debt society. The bank's job is to lend money out. So again, lending pools have become very important, because as we all know, lending is very important. And in the decentralized world, if I have cryptocurrency sitting around, I would love for it to go up in value, but as it's going up in value, I might want to do something with it. I might want to borrow some money, or I might want to lend some money. So the way this works is, if we say I have some DAI available, right? So here's the pool, and it could be, again, on any of these platforms, right? I put we'll call it my DAI, into this pool, and the pool is paying me some level of interest. Currently, it could be anywhere, right, from 8 to 12%, depending on the time in the day. And there are people who want to borrow on this side, right? And they're borrowing DAI or ETH or whatever it might be, and they pay the interest rate, which is going to be higher, 9 to 15%. And this is where the pool makes a difference. So first, the way the interest rate is determined, right, is it is simply a supply and demand graph. And what that means is if there are more people that want to borrow than there are people willing to put money into the pool, the interest rate goes up, right? There is more of a demand for the money coming out than there is a supply of the money coming in. So we move on the curve, and the interest rate goes up when the demand for borrowing is higher than supply. If, on the other hand, there are more people willing to put DAI or ETH or whatever into the pool than there are willing to borrow, obviously the the interest rate comes down, right? You have to give these people the incentive, and the incentive is they're going to have to pay a lower cost, and that cost is their interest, so they pay less. That's how the interest rate is determined. Now, that's how the interest rates are essentially determined worldwide, but worldwide they're kind of set by government organizations like the Federal Reserve, who says, based on looking at the U.S. economy, here's where we think interest rates need to be, and the Fed sets that Fed rate, which gets fed to the banks, and the banks then use it for us. And so they've kind of put in our heads, here's what interest rates should be. But essentially, banks get to set their own interest rates for the loan. So if a loan is a little bit riskier, they're going to raise the interest rates to make that loan. So essentially, interest rates normally are determined by supply and demand, but it takes a long time for that supply and demand to trickle out. The beauty here is these are based on code, or essentially an algorithm. So an algorithm creates a supply and demand, and this can be changing on a second-by-second or a minute-by-minute basis. So as there's more liquidity coming in and as there's more borrowing happening, this interest rate can always be fluctuating. So the interest rate that I'm getting is not set in stone. It's always fluctuating. The interest rate that they're paying is always fluctuating. Okay, so that's important to understand about the pool, that if I put my money in today and I'm like, man, this is awesome, I'm making 12%, tomorrow I could be making 8%. And the reason is because so many people put their money in when it was 12%, and now that interest rate goes down because now there's more of a supply than there is a demand to borrow. Something else we can look at is the purpose of all these different interest pools or lending pools that have come out, because they all really have a different purpose, right? Compound and Nuo are essentially just lending protocols. They saw this need to create this decentralized lending pool that says I can put my money in. There are people that want to just earn interest on their ETH or on their DAI, and it's just sitting around doing nothing, and there are other people that want to borrow, and so rather than having this peer-to-peer where I have to get in touch directly with the borrower, they just said, we'll just create a pool, and that pool will create liquidity. These have developed the lending needs for other purposes. DYDX developed their lending specifically because they kind of have their own exchange of hedges, right? And so they've created derivatives of different, currently different cryptocurrencies, right? So you can have a derivative that, for instance, is negative ETH, right? So if the price of ETH goes down, the value of the derivative goes up. So DYDX essentially has their own exchange, their own tokens you can exchange that are based on these derivatives. But in order to get people to actually invest and buy the derivatives, they had to create some sort of margin ability. They needed to create the ability for me to do, say, a 2x ETH. That means there's going to have to be some borrowing there, right? Because what this says is if the value of ETH goes from 150 to 200, and I've got one of these, I'm going to make $100 instead of 50. Right? Well, the borrowing has to happen somewhere. Someone has to be provided some liquidity to some sort of pool for DYDX for this DApp to be able to pay me my extra $50 because the price of ETH only went up 50, but I make 100 because of the exchange. Anyway, I will go into a whole video on DYDX at some point, but the idea is they had to create this lending ability in order to create the to be able to provide derivatives like this. This company, B0X, has developed Torque and Fulcrum essentially to add on to a lot of other dApps and have those dApps be able to provide margin lending or be able to provide liquidity. Now, Fulcrum is their own. You can go into Fulcrum and either make a loan, put money into the liquidity pool and be earning interest or borrow from it. But essentially, it's created to add on to other DeFi dApps or add on to other companies or other protocols so that they're the back end kind of providing that liquidity seamlessly, hopefully, and they're added on to other features, other exchanges, other wallets, whatever it might be, to be able to provide margin lending or something else. So the liquidity pool or the lending pools are really important. Now, something that we keep seeing in these words we keep seeing that I want to address that I've talked about several times. One of them is liquidity. Okay, and so if I am putting my DAI into this pool, I am becoming a liquidity provider. What's the liquidity? I'm putting DAI in here, which means other people can borrow. What we'll see, talking about some other videos, if we talk about DEXs like Kyber Network or IDEX or something, when you are a liquidity provider, I'm providing this DAI in here so that these other people can borrow. So that is the liquidity right there. So this becomes a liquidity pool or in this case, a lending pool. But it doesn't work if there aren't more people putting DAI, adding liquidity to the system. Because as the liquidity gets added, what it does is it helps in terms of the security and the safety of my money. Because as more and more DAI is added here, you have more borrowers, because if one or two of these borrowers either can't repay or their collateral gets liquidated or something, if there are more and more of them, it doesn't affect the system as much. We've spread out the risk among all these different borrowers so that if one defaults and has to collateralize, the others are still paying interest and still able to keep up that supply and demand curve, right? Because if everyone here gets liquidated and you have no more demand, because there weren't that many borrowers, if everyone gets liquidated and there's no more demand, then I'm not making my interest rate anymore, and the whole system kind of falls apart. So you want more liquidity providers. You want more people putting their DAI or their ETH or whatever in here, so that more and more people will come out over and borrow, because the more borrowers you have, the more liquidity you have, and the system kind of secures itself. And it takes care of its own risk by having more and more liquidity providers in the system. So I hope that helps a little bit. This is something that was kind of requested. I will, again, link to the white paper that talks about all these different lending protocols. I didn't talk about MakerDAO in here. That's a really important one. It just works very differently, and that has to be kind of its own video. And I'll probably do videos on each of these separately, but I wanted to talk about this. We talked about liquidity. We talked about how the interest rate is determined and how we're essentially creating a pool here. Pooled lending, which is more akin to how, say, a bank works, than peer-to-peer. We'll go into peer-to-peer in another video. Right now, this is the lending pools and interest. Hope you liked the video. Don't forget to subscribe to us on YouTube, on the web at interaxis.io is the website, on Twitter at interaxis8, the number 8. Find us there. Let us know if you like the videos, and let us know if there's anything else you want to see. Thanks.